Ryan.
James, how you doing?
Doing great. Good morning.
Good morning.
It is a good
morning to you. Yeah, it is. It is.
Hadn't left September into October, but we still got to look back at September as much as we might not want to.
We've got to look back, and we walked, the summer out, and
we walked the summer out.
Yeah, we walked the summer out. It's getting a little bit of a chill in the air here in Michigan, and chilly September in the markets too, huh?
Yeah. If we look back, let's update everybody with what happened in case we didn't catch it.
Yeah. Well, before I shock you all with the details, I want to just get on record that if you look back at 50 plus years historical data, and then look at which months are the best for the markets in general, and just talk about equity indices, stock indices, you're going to find that out of all the months, September is the one that's got a negative average return. So I don't want to shock you when I say that the S&P 500 was down 4.52%.
Right.
So a tough month. But we kind of stepped into the month needing a little bit of a reversal, if you will, a digestion period.
Yeah.
And then you hit that seasonality and, perfect storm.
We didn't call it, but we talked about it.
We talked about it, yeah. Right. And so bonds did not escape unscathed either. Again, fixed income bonds, we always look at the aggregate bond index, which is just going to be a basket of bonds, down 2.44%. So stocks and bonds had a tough month of September.
So September's come and gone, but we still want to actually kind of dig into what was in September. And one of the things was, that is it an annual government shutdown? Is it? I feel like it comes around
down there. Yeah. Right. You know what? I mean, again, to your point, we've got to kind of inspect the scene of the crime. And you wonder, okay, well, what was it that made September a tough month?
Yeah.
Well, the seasonality aspect, okay, fine. But then when you look, I would almost have the unpopular opinion that had the government shut down, I mean, we averted that.
Right.
We kicked the can down the road.
Right.
That might have been bullish for the market.
Yeah.
It's the unpopular opinion. Certainly there's uncertainty, but if you can get politicians to do less, the market actually likes that.
Right.
If you can get, less clarity on economic data, because remember when you shut down like the Bureau of Labor and Statistics, you're not getting the data at the Fed, so they might have stepped back. But kicked the can down the road. Rates jumped on the news, dollar strengthened on the news, and that actually was kind of anticipated.
Yeah.
It wasn't this just tremendous. Where everybody gathered together and said, oh, this is great functioning government. It's like, well, it's a dysfunctioning government. You just kick the can down the road a little bit. But for now, we'll get the BLS data. We'll get, the economy will be continuing to be strong.
Yeah, and one of the numbers we did get was one that didn't get changed, right? With the Fed and the interest rates. And
yes, exactly. So we had the September Fed policy meeting.
Yeah.
And then obviously this is the place at which they decide, do they want to raise the anchor point Fed funds rate or not? Mm-hmm. And when you look at we'll call the term structure of interest rates, or it's better referred to as the yield curve, you'll find that different data points along the way here. So like longer dated treasury bonds, shorter dated, and then the overnight lending rate is the rate that the Fed impacts when they do change rates. So when you hear them say they raised rates, lowered rates, it's all at that Fed funds rate, which is the shortest term rate when it comes to the yield curve. And the thought process behind it is if they move it up, well, the entire yield curve would move up. But that's not necessarily how it works,
right?
Because they're artificially impacting that short-term anchor point, but then the market drives what happens in the market-based rates. Mm-hmm. So we've got this interesting inverted yield curve. Now I'll tie this all together here with saying the Fed did not raise interest rates. And you would think, well, my goodness, you have talked about every month that rising interest rates are challenging for markets. So if they didn't raise, well, why would the markets have acted so negatively off that meeting? Well, I can tell you why. Because there is a neutral rate that the Fed likes to adjust. It's more of a longer term rate. And again, finding that neutral rate, that went up. That little detail went up. And so you went from, let's say, 2.5 to 2.75. Might not seem like a material increase, but it's 10% higher.
Yeah.
But it also acknowledges that the Fed is not kidding when they're saying higher for longer. The market hasn't necessarily trusted them on that.
Right. They're not
But I think that market participants are starting to go, okay, well, maybe they do have to
digesting it, realizing it might be that reality.
Higher for longer. Because, keep in mind when we're looking at inflation and some of the metrics we're using, they're always looking in the rearview mirror and they're always going point to point. So year over year. Well, at some point, once the inflation is embedded, well, your year over year change, maybe it is flat to 2%, but still the inflation is embedded. The price of groceries are already up. They didn't go up anymore, but they went up so substantially that it's challenging. So it's a delicate dance here.
So talking about rates, right? And I know we usually do, 8 topics and try to touch them all. I guess I want to kind of combine one because we're getting a lot from clients and when we read things about, or even the news, when are rates going to come back down or fall?
Yeah.
But then on top of that, Ryan, do we even want that?
Right.
Do we want them
right.
to come down? I think, we might think we might, but where do we stand there?
Yeah. So be careful what you wish for.
Right.
Because typically the catalyst for that anchor point rate to come down, it's an event. And typically it's a crises event.
Yeah.
And so oftentimes the Fed keeps rates high to impact employment, I should say, get the level of unemployment up. I mean, it seems kind of backwards, but that's how they would theoretically be able to address the inflation problem. So when that unemployment rate spikes, usually something has happened, like a credit event, something of that nature, and then rates kind of collapse. But in that moment, you're not liking how rates are collapsing, and you're just not liking that. So, I mean, I think that if you were to try and support the case for what's called the soft landing, bringing the plane in softly, not a hard landing, which the Fed is notorious for creating, you would say, well, rates kind of, you see that the anchor point stays where it is and rates kind of fill in and come up. So you get kind of that upward sloping yield curve, and that's met with economic power, earnings power, all of those things that would harbor a higher interest rate structure. We kind of talked about that on a past podcast. To get to lower rates from here, it's going to require an event.
Yeah.
And so be careful what you wish for. We'll see. Now, the Fed might just do a nod towards inflation being defeated and do like a, just more figurative, like
they'll throw us at the proverbial bone.
Yeah, there you go. It's just a quick rate cut and just acknowledge, hey, we're in a little bit different place. Maybe that tightens up their yield curve for them and stuff. But let's face it, I think we have to be prepared for higher interest rates for longer. And I think that if that interest rate environment were to go back to, and we have a word for this, and we'll talk about it here in a minute, but if we were to go back to that very low interest rate infrastructure, it wouldn't necessarily be a welcomed environment. Unpopular opinion, but.
Well, looking at those rates, how does that affect supply constraints? Oil, housing, some of the variables that we're seeing out there.
And I think that the right question is not necessarily how do the rates impact that. It's more how do those things impact the rates, right? Because supply and demand, it's the basic fundamentals of economics. And when you look at two very important components of our day-to-day life, finding shelter and utilizing energy, you're finding supply constraints there. So oil. Obviously, we rely on different countries and states and policies to drive the production of oil, pulling it out of the ground, refining it, and making it available for consumption. Well, if there's a choke point anywhere, whether it's just a policy constraint, whether it's a governmental constraint, whether it's just a nation strategically not producing oil, you have to be careful there because that supply is so critical. It's that the demand might be there, but if the supply is not there, you're going to have a problem. So one of the things that we've seen with like the price of oil jumped in the month of September, and a lot of that has to do with just supply constraints. OPEC has said they're not going to pump as much. So there you go. It's not necessarily it's a demand issue or anything like that. It's more the supply side. Then when it comes to housing, so our shelter, and that finds its way into our CPI readings, our inflation readings, recognize that a lot of homes were bought when rates were very low. So a lot of Americans have very low mortgage rates. So they have a set of golden handcuffs on.
Yeah.
They really can't sell their house because the rate that they would have to buy the new house at is so high. So you're not getting supply coming online.
Yeah.
You're not getting supply coming online. So those two things keep the prices of those, what we'll say are commodities essentially, higher, and then that filters into that inflation data. So it's an interesting time, and it takes a lot of just focus on the data and anticipation of kind of that next move. And I think you're going to transition into this soon. It's just a different mindset.
Yeah. In September, it's important to look at some of the things that went into that, right? But, if we start to look at something that's maybe new or maybe new to some of our clients or, fans when they're watching this, is the idea of a ZIRP, or new regime.
I like it. Sounds like a drink or something.
That I wouldn't let my kids.
Right. Might be a fun time. Yeah, might be a fun drink. Yeah. So ZIRP, zero interest rate policy.
Yeah.
I mean, quite frankly, and I'm going to, I'll just say it. I'm 41 years old. So when I say this, it might seem a little bit weird, but recognize I'm a student of history. Mm-hmm. So prepared. If you're younger than 50, you really don't know a world where interest rates are reasonable to invest in. Inflation is kind of an issue. I mean, it's a different world.
Right.
Those who are younger than that have operated in this zero interest rate policy environment panacea, if you will, where you're lunging from big swings in the market, big capital gains and stuff. And because when you look at the capital markets, it's a system. And so if interest rates are zero, I have to go get my targeted return by capital gains.
Right.
When interest rates are higher, well, if I'm trying to achieve a certain return, I can rely on those interest rates, and I have, less work has to be done at that capital gain level. Mm-hmm. So, it's a different modus operandi. Right. It's a different mode of operation, and it's a different construct for portfolios.
Which we're on.
We're on. Oh, no doubt about that. Yeah. You have to adapt. That's the problem that I sometimes see in this industry. There's no adaptation.
No.
So mediocrity is what you'll get there.
Right.
So we have to look at things a little bit differently, and that's exactly what we're doing. But, I think that the ZIRP days are done unless we are confronted with another crisis. And my goodness, it would be nice to move on from that.
Right.
So, again, just recognize we're certainly looking at it a little differently.
Yeah.
And we'll continue to report now as we move through the coming months what's working, what's not.
Yeah. What ideas, what we're going to do.
Absolutely.
So now, instead of looking back at September,
kind
of looking forward a little bit into October, earnings, some other things that might, kind of pop up.
Yeah. So we've touched on this a number of times. Fundamentally speaking, the market seems a little bit stretched here. I mean, in order for these valuations to really work, you have to have some pretty robust earnings growth through 2024. So this is a very technically driven market. And one of our analysts, Vince Vitale, has come up with a really good system to help us track those technical movements. Mm-hmm. So, shout out to Vince. But definitely when it comes to October, we're going to get a very busy earnings season. So we'd like to see how those fundamentals are really looking. Again, when you're looking at what the market is anticipating, it's double-digit growth into 2024. Mm-hmm. Well, the path to getting there is, number one, how did corporate America do in the third quarter of 2023? But then what we'll likely be listening to is the earnings projections out into the future.
Right.
So I'm really focused on that. I think that you're going to see some, obviously, more inflation data, things like that. And we've just got to listen to the Fed. What you have in the interest rate world right now is a tremendous amount of volatility. And I'm saying interest rate world, and that's going to impact your bond portfolio. We've got a handle on it. But it's going to be very bumpy. It's going to be a lot of volatility, and those interest rates are the lifeblood to the capital markets. So as much as it'll be good to be looking at the earnings of the S&P 500, stuff like that, in the month of October, really we need to drill into how's that interest rate volatility? What's the cadence of the inflation story? So a lot of moving parts,
and we'll be on it.
Yeah. No doubt about it.
And it's exciting, actually. When you're kind of looking at this, how do we maximize our clients' positions.
We drink from a fire hose every day.
Right.
It's a challenge, but boy, it's fun.
All right. Well, we'll be back in October. And until then, Ryan, as always, it was a good day.